Hello and welcome to the lesson. Today we are going to study the steps involved in analytical review. Analytical review, candidates, is a key component of the audit process that involves evaluating financial information and relationships to identify significant fluctuations, trends, or unusual patterns. It is a systematic and logical examination of financial data, comparing the current and historical information to assess the reasonableness and the consistency of the financial statements. In our today's lesson, we'll study the steps that are involved in analytical review. Analytical review. I've defined analytical review as the systematic and logical examination of financial data by way of comparing the current and historical information to assess the reasonableness and the consistency of financial data. And I've said it is a key component of the audit process. That means that an auditor is required to carry out analytical reviews as part and parcel of the audit process. So what are the steps? Steps involved in analytical review. Number one is understanding the business. Understanding the business. The auditor gains a thorough understanding of the entity's business, operations, industry, and economic environment. That's the first step in analytical review. And this understanding helps in identifying the key drivers and factors that influence the financial performance and results. Understanding the business helps the auditor to know the key drivers and factors. The key drivers and factors that influence the financial performance and the results of a business. So the first step in carrying out analytical review is to understand the business, understand the operations of the business, understand the industry in which the business operates, understand the economic environment. And by so doing, the auditor understands or comes to the knowledge of the key drivers and factors that influence financial performance and results. The second step is to identify the significant accounts. Identify identifying the significant accounts as well as the relationships. Understanding or identifying significant accounts and relationships. Now here, the auditor determines the significant accounts and relationships that are material to the financial statements. That are what? That are material to the financial statements. And this may include revenues, it may include expenses, may include assets, liabilities, and any other key performance indicators. The third step is to collect and analyze data. The auditor gathers here relevant financial data from various sources, including the financial statements, the general ledger, the trial balances, the budgets, industry benchmarks, and any other external market data. And the data is then analyzed in order to identify trends, to identify ratios and patterns. Collecting and analyzing data is the third step. Then, candidates, the fourth step is applying analytical procedures. applying analytical procedures. Applying analytical procedures. The auditor applies various analytical procedures to the financial data in order to detect any anomalies or inconsistencies. And that may involve collecting or comparing current financial information with the prior periods. Comparing the current financial position or data with trends or industry benchmarks. Can also compare the current financial information with the budgeted amounts or any other internal or external data sources. Analytical procedures. All right? I've given an example on how that can be done. Compare, for example, the current financial information with the prior periods, with the budgeted amounts, with the benchmarks, with the other internal and external sources. And the purpose for comparing is so that the auditor can detect any anomalies or can detect any inconsistencies. 5. Investigating significant variances. Investigating significant variances. We've here seen how the auditor can compare the current financial information with the budgeted information and so on. So after comparing, there could be significant variances. And any significant variances or deviations from expected results are then further investigated in order to understand the underlying causes. And that may involve inquiries with management, obtaining additional supporting documentation, performing substantive tests, or seeking external expert opinions. Investigating significant variances. Then lastly, documenting findings. Documenting findings. The auditor then documents the results of the analytical review process, including significant findings, explanations for variances, and also conclusions reached. And this documentation serves as evidence of the audit procedures performed and provides a basis for audit opinion. Because candidates, the objective of analytical review is to identify areas of potential risk or material misstatements in the financial statements, and it helps the auditor in assessing the overall reasonableness of the financial information and also assists in determining the nature, the timing, and extent of further audit procedures. And the candidates, is important to note that the analytical review alone is not sufficient to form an audit opinion. It is typically combined with other audit procedures such as tests of detail, and substantive testing in order to obtain sufficient and appropriate audit evidence. So these are the steps involved in analytical review. The first one is understanding the business. Number one, understanding the business. The purpose for understanding the business by studying the industry, studying the operations of the company, is to identify the key drivers or factors of financial performance and results. Then the second step is to identify significant accounts and relationships. The third step is collecting and analyzing data. Number 4, applying analytical procedures. Number 5, investigating significant variances. Then lastly, documenting findings. And that will mark the end of our today's lesson. Thank you for attending. We'll meet you in our next session where we'll study evidence and testing considerations. Thank you.